Okay, so we're looking at the capital asset pricing model. We're trying to tabulate the cost of equity. When we talk about the cost of equity, we're just talking about the cost of equity financing. This is the minimum return the shareholders are expecting basically to make them happy. All right. So this capital asset pricing model is got four components that you must remember. Okay, I'll actually put them as five. Okay, the first is the risk-free rate. Colleagues, when we mean risk-free, we mean there is no risk attached when you invest in that security. So theoretically, the securities which are risk-free are the government treasury bills. Government is the one that prints the money, so theoretically they can't fail to pay you. Okay, so if you buy a government treasury bill, okay, or any other government securities, there is no risk that you might not get paid your interest payments and when the debt matures, your final payment. Okay, so when you hear risk-free rate, it's just the return which is attached to government securities. Any questions? That's the first component. Okay, before we come to market risk premium, first let's look at equity beta. Okay, beta measures risk. All right, measures risk of the shares for that company. Okay, the higher the beta, the higher the risk attached to those shares. The lower the beta, the lower the risk attached to those shares. All right. So to be specific, the type of risk this beta is measuring is what we call systematic risk. Okay, systematic risk. This is a risk that affects the entire market, the stock market, basically. Okay, all companies that are in that stock market, like the Osaka Securities Exchange, there's certain risks attached to them that affect the stock market. These risks can come from inflation, interest rate changes, political instability, and economic recessions. Right? So equity beta is just measuring risk. Okay. The equity beta for the stock market is usually measured as one. So one is like the threshold. Okay. So any equity beta above one, it is those shares are risk. Okay. You can invest and you find you don't get your returns. Okay. Any equity beta that's less than one, it means those shares are less risky. So you can invest and you know that, okay, you're going to get your returns when you invest. Then you've got the return on the market. Okay, the average return earned by all stocks or all shares in the market. Okay, so if we say the return on market for the Lusaka Security Exchange, LUSE, is 10%, it means on average, if you invest in any company there, the Lusaka Securities Exchange, you are going to at least earn an average return of 10%. Now, this return on market, when you subtract it from the risk-free rate, that's when you get the market risk premium. This market risk premium is just the additional return that you get when you invest in shares in the stock market as opposed to risk-free investments. Okay? Because with the stock market, securities with high risk expect high returns. Securities with no risk expect low returns. So if you choose instead to invest in the shares of companies instead of investing in government securities, you're going to get an extra return. And that extra return is called the market risk premium. Okay, it's just the additional return you get from investing in the stock market over risk free securities. Okay, and then cost of equity here it is minimum return a company must offer to attract investors to buy its shares. That's on the investor side. Okay, on the business side is the cost of equity financing, but on the investor side is the minimum return. Okay, yes. So here's the formula for the capital asset pricing model. Okay, it's your risk-free rate plus your equity beta, open brackets, return on market minus risk-free rate. So this return on market minus risk-free rate, this is the risk premium we talked about. Okay. Yes. So basically, in simple words, this capital asset pricing model formula, what it's just telling you is the higher the returns, the higher the risk, the higher the returns, basically. If we increase the beta, okay, what you notice is with this formula, if you increase beta, okay, the required rate of return on the investor side is going to also increase. Okay. Yes. So it's just saying us in simple words, higher risk, higher returns. Low risk, low returns. Okay. So I believe in the exam, I don't know if they will provide this formula for you, but it's an easy formula to remember. Risk-free rate, RF, plus equity beta, RM, minus risk-free rate. Okay. This is the formula. So when you're dealing with questions for work, if you see in the notes, they just mentioned this beta. The moment they mention beta, just know that you're using this formula. Okay, colleagues? That's the trick here. In the question that will be given, if you just see they mention a beta, they know you're using the capital asset pricing model. Okay. So here's an example. Okay. We've got information here. The risk-free rate is 3%. Market risk premium 7%. Beta of the stock 1.2. Right, we have to calculate the cost of equity, which is on the business side, or the required rate of return on the investor side. Okay. Remember that, colleagues. When you say cost of equity, you're talking on the business side, cost of equity financing. When you say required rate of return, you're talking about on the investor side, okay, the minimum rate that they expect. Okay, so some questions they will tell you the required rate is this amount. Okay, just know that that required rate is also your cost of equity. I hope we are clear on that part. So we use a formula here. Okay, risk. So cost of equity. So our risk-free rate is 3%. Equity beta 1.2. Market risk premium. So they've already subtracted the return on market minus the risk-free rate. They've already subtracted for you. So you just put here 7%. So 3% plus 1.2 times 7%, what do we get? If you want, you can leave them as percentages, okay? Because if you convert them into decimals, at the end you need to convert it to a percentage again. So you can leave as percentages. Yes. So 1.2 times 7. 8, okay, 8.4%. 3 plus 8.4%. It means 11.4%. Yes. That is the cost of equity, or that is the